Hi everyone, my name is Nick from the Ardcon group, based in Melbourne, Australia. Throughout our educational videos, we hope to show you that entering the property market is actually more affordable than you may believe. In this educational video, I would like to talk to you about the benefits of understanding property tax depreciation with regard to purchasing an investment property. To start, let me explain to you what property depreciation is. Property depreciation is an allowable deduction which reduces your assessable income for tax purposes. When you buy an investment property, the income you earned less any allowable deductions is included as part of your annual income tax return. Property depreciation actually identifies the decline in the value of items within your property as well as the building itself. Put simply, the Australian Tax Office, known as the ATO, does not allow you to claim tax deductions on your home. However, it does when it comes to an investment property. The ATO breaks up the property tax depreciation into two main categories. The first category covers the items within the building, which are classified by the ATO as plant and equipment. Examples of these include a dishwasher, a stove, an oven, or even blinds. Basically, anything in the property that will eventually break down over time is considered plant and equipment. The second category is the building itself, which the ATO classifies as a building allowance, or Division 43, which allows you to claim depreciation on the structural elements of the building. For example, the floor, the roof, and the walls. Taking advantage of property depreciation is all about maximising your money. Would you believe that 70 to 80% of investors don't take advantage of property tax depreciation and other tax-related benefits? Yes, you invest in property for the future, and yes, it costs you money, as any investment does. But making sure you claim all allowable deductions ensures you don't pay too much. You work hard for your money, so you need to know how to hold on to it. Understanding property tax depreciation can be difficult, so please allow us to make this process as easy as possible for you, as we show you two key examples of how this process would work for you. These figures, provided and certified by BMT quantity surveyors, were specifically issued for both a 1 and 2 bedroom apartment on a recent Ardcon group project in Preston. Okay, let's have a look at the first example with you. We are going to break down an estimate of depreciation claimable for a typical 1 bedroom apartment based on a recent Ardcon project in Preston. The three figures I'll show you in this graphic will demonstrate your claimable figures for plant and equipment and building allowance, also known as Division 43, and their combined total. I will run through the first 3 years in this example. However, please pause the video when appropriate to get the full schedule. So as this is an estimate, you must remember that this is not an exact amount you may be able to achieve, but at least take a good look at the guide to see what you should expect. In this example, I am only going to cover the maximum depreciation claimable. However, the minimum depreciation claimable is still visible on your screen. The minimum and maximum depreciation claimable would vary depending on the value of the individual items within your apartment. In the end, it is your quantity surveyor who will assess this and provide your exact figures. Looking at the first year, you could claim up to $6,937 for plant and equipment and $3,818 for Division 43, coming to a total of $10,755. For the second year, your claimable amount for plant and equipment could be as high as $5,239, while your Division 43 figure would stay constant at $3,818, totaling $9,057. As you can see, the maximum claim for Division 43 remains set at $3,818. This is the same for every year, up to a maximum of 40 years. You may also be wondering why your claimable amount for plant and equipment decreases each year. We mentioned earlier that plant and equipment refers to any item within the property that could break down over time. It makes sense that an item loses its value over time, therefore the amount we could claim on this item also decreases. Moving on to the third year, you could claim up to $3,722 for plant and equipment, with Division 43 again at $3,818, which comes to a total of $7,540. Looking at the bigger picture of your maximum depreciation claimable, you are able to claim a total of $19,812 in the first 2 years. In the first 3 years, it's $27,352, and over 5 years, you're looking at almost $40,000. Over 10 years, that figure could be as high as $63,000. Taking into consideration the 40-year lifetime of the building, you may be able to claim a total of $178,378, which is pretty remarkable. Now that we have looked at a one-bedroom apartment, let's look at an example for a typical two-bedroom apartment. Once again, this example is taken directly from an estimate specifically drafted for a recent Preston development. So looking at the first year, you could save a maximum of $6,885 for plant and equipment and $6,971 for Division 43. This comes to a total of $13,856. Now you may be wondering why Division 43 figure is higher for this example than the previous one-bedroom example. The reason for this is because this figure is based on the size of your apartment pro rata to the rest of the building. The bigger apartment, the more of the whole building it takes up, therefore there is more to claim. Moving into the second year, your claimable amount for plant and equipment could be $4,237, with Division 43 being again constant at $6,971, which totals $11,208. Already in 2 years, that's a claimable amount of $25,064. In your third year, you're looking at a figure of $3,169 for plant and equipment, and again $6,971 for Division 43, totaling $10,140. This means that in only 3 years, your claimable amount would be $35,204. Now, fast forward to the 5th year of owning this two-bedroom apartment, and your claimable amount could be $53,264. Or even fast forward to the 10th year, and you may be able to claim as much as $92,252. And lastly, looking at the 40-year lifespan of your purchase, you are looking to be able to claim a total of $303,449 as a maximum amount. This could be over half the value of your original purchase. Remember, you don't have to do extra work to earn this result, just be smart. As we mentioned earlier, the claimable amount for plant and equipment on an annual basis has reduced. This is because the quantity surveyor has used the diminishing value method to calculate the plant and equipment depreciation in our examples. There are in fact 2 methods of calculating depreciation. However, your quantity surveyor should help you choose the best option. It is important to know that whilst a quantity surveyor helps you to maximise your savings with regard to your investment property, they work alongside your accountant. The claimable depreciation assessed by the quantity surveyor are passed on to your accountant to apply to your tax statement come tax time. It's fair to say that these figures look impressive. If you'd like a more detailed breakdown on how these figures were reached, feel free to call or email us here at Ardcon Group using the details on your screen. We have an experienced team that are willing to help you gain a better understanding of the principles of property depreciation and in fact the whole investment process. In saying that, as this educational video comes to an end, we do have a module in our educational series that helps to explain where these great figures fit into your tax. We will help to show you how investing in property can be more affordable and assist you in getting into the property market. Thanks a lot for your time today, and I hope you found our knowledge valuable.